Good morning, Becky. I'm here at Amelia Island at the Atlanta Fed's 29th annual, is that right?
That's it.
Financial Markets Conference with Atlanta Fed President Raphael Bostic. Thanks for joining us, Raphael.
It's good to see you, Steve. Good to have you here.
I have to start with the news over the weekend, or Friday, which came out, the downgrade by Moody's of the U.S. debt. Is that an economic issue? Is it a policy issue? Is it a financial markets issue? How do you think about an event like that?
Well, first of all, it's really good to have you here,
Thanks.
and I'm always happy to be on the show. What I would say is it will cut across all of those things, and we'll just have to see how it plays out. You know, there's a lot of negotiation that's happening in Washington right now around the budget, around tariffs and the like, and I think we'll just have to see what happens. But with that downgrade, it will have implications for the cost of capital and a bunch of other things, and so it could have a ripple through the economy.
What about the impact on the desire, for example, of banks and foreign institutions to hold U.S. debt?
Well, there have been a lot of discussions about this. I know folks on this show have been talking about that as well. I think we have to really wait and see. Look, there's a lot of turbulence that's happening right now. The economy is in a lot of flux, policies in flux. There's a lot of uncertainty. I think we'll have to wait 3 to 6 months to start to see where this settles out, and I think that'll be an important determinant about people's willingness and appetite for investing in the U.S.
How does something like this get to the Fed's door? You don't deal with the spending or the revenue, but you have to deal with the outflow or outcome of it.
Yeah, so for us, I think the most significant way this plays out is really by us having to get an understanding about what businesses are going to do in this new environment, how households are going to respond, where our consumers going to take on higher price if that's in fact what happens,
right,
and then roll that up into an outlook for the future. What I will say is today, things are very much in flux. There's a lot of uncertainty, and what it means for me is, before I want our policy to move in any dramatic direction, we've got to let things sort out a bit. So that's kind of where I am right now.
Talk me through how you think about tariffs and the economic effects of them. There's a consumer angle to it, there's a business angle to it, and a financial markets angle to it, which a lot of people are talking about here. I don't want to know what data you're looking at, but what processes are you trying to figure out?
I think for me today, there are really like 3 things I'm trying to understand. The first is, once we see what the final regime is in terms of tariffs across the globe, how do businesses respond to that? Do they pass through all of it? Do they try to pass through some of it? Or do they take that in margin? The second is really, how do consumers respond to whatever their business response is? So in the last episode, consumers basically took on the price and they paid it. It is unclear whether they will be able to do that today because their balance sheets are weaker than they were in the past. We don't have the same level of support. People have just lived through a high level of inflation, and so there may be greater sensitivity, which could slow down things and cause them to be much more responsive. And then the third is really, what does this mean for inflation dynamics? Are we seeing, the basic theory is tariffs are just a one-time bump and then you go back. Is that how this is going to play out? To the extent that this tariff transition happens over a longer period of time, it could induce businesses and families to change their strategies in ways that wind up being structural. If that happens, then we will have to take that on board from a policy perspective.
Is there a difference in the sequence of when any of this shows up in the economic data, in the sense that you could imagine that payrolls could react immediately, but inflation takes time to figure out? So you could, in the words of Jason Furman, he said, the Fed is right to be waiting behind the curve because the danger is that it ends up being ahead of the wrong curve. So tell me about how you think about those two things.
Yeah, so we worry about this a lot in Atlanta. We do a bunch of surveys where we ask CFOs, we ask businesses like, what are you going to do, expecting to do for the next 12 months? And we get that on an ongoing basis. That gives us a look-ahead peek, so that the difference in time periods and adjustments don't necessarily, while they may play out that way like in the marketplace, in the psychology it doesn't. CFOs know, well, we're going to have this different cost structure, so prices are going to have to move them. We try to get on that as soon as possible.
Let me just do one question. I know Becky wants a question back in headquarters, but I have one other question to you. I learned Latin when I started covering the economy here, and there's this ceteris paribus idea, which is all things being equal. You guys had plugged in, on average, 2 cuts in the last SEP. Is that still a bias that you have? Do you think that if you could figure out the tariff regime, if you could figure out what was happening with employment, that you would still be cutting rates twice?
Well, it depends, right? So I'm an economist, one hand on the other hand, right? But I would say this: it really depends on how things turn out. You know, at the beginning of this year, when we were thinking about tariffs, we were not thinking about them at the level that has been proposed here, or with the diversity across sectors and across countries, right? That requires a different kind of calculus, and for me, that's one of the reasons why I said, okay, we got to step back and pause, because the details are going to matter as to what it means in terms of flowing through to an aggregate picture. So for me right now, I'm expecting it's going to take a bit longer for that to sort out. I'm my SCP, I'm leaning much more into one cut this year, because I think it will take time, and then we'll sort of have to see. There are some scenarios where everybody grabs hands, they walk arm in arm, they're buddies again, and we wind up with a very different regime where tariffs are not an overarching story. And in that case, you might see the economy rebound much faster than it would otherwise. But really, we'll have to just wait and see.
Becky, thanks for waiting.
Oh, no, thank you, Steve. President Bostic, I just wanted to ask a question about the health of the Treasury market as you see it right now, because the FOMC sets rates, they set the policy, but ultimately it's the Treasury buyers that determine where interest rates will be. This morning we're looking at the 30-year up by about 12, maybe 13 basis points. The 10-year's higher as well. I guess the question is, do you think buyers are going to show up? And are there all of these questions around the downgrade coming from the United States and what Congress ultimately does in terms of budget they set, and whether they're going to tackle some of the deficits that have been building up for over a decade?
Well, it's something that we definitely are watching and keeping tabs on. Today, what we're seeing is that Treasury markets still are functioning quite well, and that's a good thing for us. I would say for me, I'm worried much more at this stage about just trying to figure out what's happening with our mandates, right? So we have inflation, which has been not moving toward 2% as fast as I'd like. We've had labor markets that have been solid, but we are definitely seeing signs of weakening. And those are the things that I spend most of my time focusing on. If Treasury markets start to get more complicated, then I'll have to really think hard, and I'll work with my team to figure out what that means for our policy and our mandate. But right now, I'm trying to stay really focused on the things that we're charged with doing.
I mean, I guess I ask because the last 100 basis points that the FOMC cut, you actually saw interest rates go higher. Didn't matter what you all were doing.
Well, look, as I was saying earlier, this is a very complicated time, and I think investors more broadly are seeing a lot of uncertainty moving forward, and uncertainty does mean that there's higher risk. And so we control only part of the cost of capital and debt. And so that's what we got. So there's a lot of other actors out there, policymakers and other countries that are going to make decisions that will ultimately decide that level. But we're really just trying to get our mandates and our targets back to where they need to be.
Raphael, over time, what do you think about the kind of restraint that the bond market can exert on the economy? When you're up at these levels, is that more restraint than you'd like it to have, or how do you think about that?
Yeah, I don't know that I have an optimal level of restraint or restraint. Right. What I would say is, as things get more expensive, it changes the choice set. And policymakers will have to take that on board. Households will have to take that on board, and businesses will as well. And what it will ultimately do is affect the level of investment that you see, both in terms of a household and a business perspective, and that will influence the trajectory of the economy, and that's something that we are definitely trying to pay attention to.
The question I asked the Fed chair at the last press conference, I'm going to ask you as well. Which side of the mandate do you see more risk? At which side of the mandate do you see more risk? Is it the employment side? Is it the inflation side?
So that's a really hard question.
That's why I think
that's why you keep asking it. Look, here's what I would say. I think today, given the trajectory of our two mandates, our two charges, I worry a lot about the inflation side, and mainly because we're seeing expectations move in a troublesome way. The short-run expectations have gone up a lot, and some of the longer-run expectation measures are starting to migrate. That will make our job harder in terms of getting to that level. To date, some people are saying there are lots of clouds on the horizon from the employment side, but we haven't really seen that. And when we talk to businesses through surveys and other means, they're all telling us we're still going to just sit tight. We don't have plans for large layoffs. There are contingency plans that are being formed, but today we're not hearing that those things are imminent. So given that that's at full employment or close to that, I still worry a lot about the inflation.
Are you surprised at this point, and I've done a lot of work on this, which is we've never had a drop in sentiment like this outside of recession. Are you surprised? Every week I look at the jobless claims, they're low. All of what we describe as the hard data is okay. How do you explain that?
Well, if I could fully explain it, I would be doing something different, I think. But here's what I would say. People are seeing in the news a lot of change. And a lot of change that has implications that could be potentially negative. But that stuff has not actually played out in the marketplace. The latest numbers that have come out, my team tells me that we're not really seeing the impact of the tariffs in pricing and in how the economy is being experienced by people. But everyone feels like it's coming. Yeah. And that becomes a bit of foreboding that causes people to worry. Now, we know that inventories, a lot of people front ran the tariffs. That is starting to come to an end. And so we may be getting to a point where we will start to see if that distance between sentiment and behavior starts to narrow and align. But we're not there yet. I was a psych major undergrad, So I definitely do think that psychology matters, and I'm going to be watching that very closely.
Andrew has a question.
Raphael, I have a question that I think sort of gets at maybe where Steve was going with a couple of his questions around employment and inflation, and want to just get your reaction to this. This was Kevin Warsh. I don't know if you saw. He had a sort of a very critical, some critical comments about the Fed out, and of course he's somebody that has been floated as a possible contender to take Jay Powell's job eventually next year. And he said this just last week. He said, quote, "At the Fed, when they talk about how we get inflation down, what they really mean is how do we get the unemployment rate up? We need to throw people out of work to get the inflation rate to come down," which is nonsense, he says. But that's embedded in economic thinking, including at the Fed. What do you think of that?
So you're never going to hear me say that it's a bad thing for more people to be employed. I actually don't think that is something that is really in my mind and in the conversations we have in our building. That's not really what we're trying to get to. We are trying to maximize employment. That is a charge that we have, and we're always going to do that. Now, sometimes it will be the case that inflation, on this show, you all talk about how there are times when our two mandates are in conflict, and we have to weigh that. But the goal is not to throw people out of work. The goal is really to have an economy that is stable, that allows businesses to invest in ways that maximize their productivity, and that allow households and families to invest in themselves so they have the best quality of life as possible. That's really the charge that drives me and motivates our team every day.
Raphael, one of the reasons I'm here is, well, first, what a great host you guys are. But the other thing is all the people who are the people I call when the financial markets start to melt down, they're here. So it's a very sunny group, as you might imagine. So here's my question to you. Back in April, when the bond market was selling off, the stock market was selling off, and the dollar was weakening, how close did it feel to you we were to another episode, so to speak?
It was unclear. I didn't feel super close. Like this was not like the Great Recession, like in those moments before.
The pandemic, it wasn't.
The pandemic was actually quite different in the sense that there was a lot of just non-economic stuff that we were trying to sort out that was really kind of significant. I did feel like there was a lot of turbulence, and the thing that for me was most present in my mind was this idea that people were realizing that the environment was very different than what they had expected. Right, when we were talking to people in financial markets, we were talking to businesses, they were not focused on significant large changes in a tariff regime. They were thinking about deregulation, they were thinking about a lot of those things. When that worldview gets altered, I think there's a potential to see a pretty significant change in people's mindsets. I think what we saw through that whole period was a marketplace that was coming to terms with a different reality than what they expected.
And now it's another reality, which is one that's better, but are you still concerned about the idea that these tariffs are, people are saying a 15% average tariff, 30% on China? Is that still economically significant?
It's definitely economically significant. Look, our folks were running models and we were doing projections of tariff regimes that were less than this, and we saw economic impacts. So there can be impacts here, and you know the Yale Budget Lab, there are a bunch of analysts externally who have said, look, if these tariffs stay at these kind of levels, the projection is that we will see significant upward pressure on prices, and that's will be something we have to take on board as we battle to get inflation back to our 2% target.
Raphael, thanks for joining us today, and thanks for having us down here.
Always good to talk with you. Look forward to next time.
All right, back to you guys at NASDAQ there, Becky and Andrew.